Hello and welcome to FidelityConnects. I'm Pamela Ritchie. A global bullish broadening is happening while allowing high waters to lift all boats, it seems. The powerful U.S. hyperscalers are taking a relative breather as other capsizes and industries trade higher into their times in the limelight. All whilst the international trade continues to have legs, though the geopolitical overhang is pretty heavy today, been putting pressure on markets. Our next guest says that a balancing out of various market factors along with momentum to accelerate into a secular AI transformation appears to hold and also bode well for investors. Joining us here today to discuss his latest look at markets through charts and graphs he's prepared for you is Fidelity Director of Global Macro, Jurrien Timmer. A warm welcome to you, Jurrien. You're on the West Coast, I think. Hello.
Yes, good morning from Santa Barbara.
Good morning. We'll invite everyone to send their questions in over the next little bit here as well. Let's go into, we know that there's an awful lot of news going on in the world right now. It's actually sort of a relief to focus on what markets are actually telling us. So you'll go through that and tell us a little bit about, I guess, what they are able to power through. How would you put this?
Yeah, so, the number of headlines that we've had to endure now, not only for the last few weeks, but the last year plus now, obviously is it can be confusing, can be disturbing, can be all of the above. But the charts are the charts. And to me, this is a good practice every week to just say, okay, we know what the markets, we might know what we think, or we think we know what the market should be doing based on tariffs, based on this, based on that. But what are the charts actually saying? What are the markets actually doing? And the markets, of course, are brutally efficient, they're brutally rational, they're very left brain analytical. They do overreact sometimes or react sometimes. But looking at what the charts are saying, I think is a good sort of sanity check for me at least, to see, okay, underneath the headlines, what is systemic, what is not, what are companies doing. It always comes down to the same things: earnings, interest rates, sentiment, etc. And what I'm seeing is that we've had this big AI boom, of course, and we still have it. And my worry always was, what about concentration risk, right? If the Mag 7 ever start going down or stop going up, does that mean the market can broaden in a good way or in a bad way, meaning that the indexes get dragged down? And what we're seeing, at least right now, and it's only a few weeks underway, is that the markets are broadening in a good way. The Mag 7 are taking a rest while the rest of the market is accelerating. And we can see that in slide 2, where you see the S&P cap weighted index, which is the one with the blue line, is not going down, but the S&P equal weighted index is accelerating higher. So it's a good thing to see. And it's good to see that the markets are focusing on what they should be focusing on, and which is the fundamentals of corporations and their earnings and their cost of capital, etc.
Let's see if we can pull this one up. This is slide 2 that we're taking a look at right now. It's the S&P 500 index. There it is. Yeah, exactly. Good.
Yeah. So you see the S&P equal weighted in the purple is breaking out. But it's not coming at the expense of the S&P cap weighted index. And if we go to the next slide 3, you can see that even more clearly, where this is a chart of the Mag 7 at the top, and it's been in a holding pattern now for the last few months, which is good. It's good to see, because they can't lead forever. The question for me always was, if they don't lead, does that mean they drag the market down? And what's actually happening is that you see in the bottom, the breadth numbers, the percentage of stocks above their 50-day moving average, has gone from 32% in November to now 73%, while the Mag 7 are essentially treading water. And that is a nice thing to see, because it gives that broadening that we've all been sort of waiting for and hoping for, a chance to really shine.
And tell us a bit about, okay, so we go into the bubble territory, or if it's just sort of a longer boom, I guess, is what we're asking. And it looking at valuations being able to hold themselves up sort of suggests it's a boom, and we continue on with it.
Yeah, so let's go to slide 4. About 3 months ago, this was a big question. I remember we were at one of the Fidelity Canada conferences at the time, and I got a lot of media requests to ask about AI bubbles. That was the time when sort of the what I call the cats and dogs of the AI boom were really flying. So the non-profitable tech and all of those smaller companies, and the big talk was, is this turning into a bubble? And my answer was not yet, but it could. And now, 3 months later, those cats and dogs are all pretty well behaved, and investors have been asking the tough questions of the Mag 7 and the AI boom about the vendor financing, and is it going to be a zero sum? Is it Google versus Nvidia, this and that? And the fact that those questions are being asked, I think, is very constructive. And so we go to my analog here of the late 90s, and you can see in the top panel, the S&P continues to track very closely from its April low to the analog from the 1998 low. And that, on the surface would give us pause saying, okay, is it going to end as badly? But when you look under the hood, for instance, in the bottom panel, I show the Cisco PE back then, because that was the poster child of the internet boom, to Nvidia's PE, they are not following in sync anymore. And if you look at many other metrics, the market breadth, for instance, it is not the same thing. So my sense is, price analogs always are great until they stop working, and they
Right.
always stop working at some point. My guess is that this one will stop working um, uh, by the market not following the downturn
Interesting.
that happened in
Right.
2000, because we just don't have the markings of a bubble at this point, even though the PE at 25 is high. But underneath the hood, we just don't see the extremes that we did back then, and that obviously is a good thing.
Absolutely. And when we talk about last week, I think we talked a little bit about things evening out, some normalization, some discussion, again, which just seems anathema to what's going on in the world. But we're focusing on sort of the markets getting their balance back and getting to a spot where things are so-called normalized. That's continued. And you have a chart on this that just talks a little bit about, I guess, again, it's the evening out of that fear talk. I mean, are we talking about sentiment just chilling out a bit?
Yeah, so if we go to slide 5, so again, 3 months ago, there were all these high flyers, right? There were the nuclear stocks, there were the quantum computing stocks, the non-profitable tech, the meme stocks, the Bitcoin sensitive stocks, because there was a hyperscaler element to that. And one way that I track that is by showing this sort of spaghetti chart at the bottom, which are relative momentum curves for all of these little equity baskets that I track. And again, a couple of months ago, there were some real outliers there. And today, they're all pretty, kind of in the pack, if you will. And so that doesn't mean it won't happen again. But at this point, it seems like a fair amount of balance has been restored in the market. Again, on a variety of different metrics. And that tells me that the market actually is somewhat in balance right now, even though the world certainly doesn't feel that way at times.
No, it really doesn't. So it's sort of fascinating. Let's get a bit to the earnings picture. So we've started earnings. There isn't a lot to sort of sum up at this stage, but it also is yet another piece of the story of whether stocks are valued properly, because we're going to hear from companies and see whether the hyperscalers, but also other companies, are actually turning AI into something that is affecting their bottom line, or there's a sight line to when it will affect their bottom line.
Yeah, and so let's go to slide 8. And of course, the glass half full view of what's happening with this broadening is that the AI dividends are being paid, right, in terms of downstream effects on productivity, even on inflation, and I'll show you an inflation chart later. But for now, again, back to the topic of balance, this is the chart I show all the time. And you see on the top that the market is well above its rising trend line. So you could argue market's overbought, it's going to mean revert. It's not a great timing tool, but the market is priced for success. You can see that. But if you look below, you see the earnings component and the valuation component. And right now, earnings are up 12% year over year. The PE ratio is up 2% year over year. And of course, then you have dividends, which are about 1.4%. You add them all up, you get the year over year return for the S&P. And most of it is coming from earnings. And that's a good thing, right? You don't want to see most of it coming from valuation, which is what we had back in 2023 and early 24. So that's a good underpinning, if you will. And if we then go to the next slide, 9, we get into kind of the discounted cash flow math of what is the market actually priced for. And there's a whole heat map here, but currently if you look at, so earnings are growing 12% year over year. Their 5-year growth rate, the CAGR, is 14%.
Yeah.
If you look at the earnings estimates for the next few years, the expectation is that earnings will continue to grow at 14%. Now, that's, of course, very high, right?
Very
Historically, they grow at 7. So the market is pricing in a 2x normal earnings growth. And of course, the valuation is going to reflect that, because the way the DCF model works is that, earnings go in the numerator, interest rates in the denominator, and the fair value is the present value of future cash flows. So at a 14% earnings growth, if you kind of track that from the chart down to where the blue box is, that is a risk premium of 4.3%. So that's, I think, the most elegant way of looking at valuation, not so much as a PE, because the PE uses earnings either trailing or next 12 months, but that's, equities are a long-term asset, so the next 12 months even is not an accurate reflection. So the ERP, the risk premium, is a better measure. So at 4.3%, it's below the average of 5, but it's not at nosebleed levels. And so for me, the risk is for the market, is that if earnings end up not panning out at 14, but they end up at 10 or at 5, then in order for the price to make sense, the risk premium would have to go way down to levels that are not sustainable. And then the price has to adjust, or the PE has to adjust. And that's how I think about valuation. So 25 is not high or low. It just depends on what kind of earnings it's priced for. But clearly the market is priced for success here. There's no two ways about it.
I mean, let's take that to the story of the global marketplace, which again has been something that many investors have entered this year thinking that there will be a continued success story there, both for sort of developed markets and in some cases EM as well. Today it's off in Europe because they're getting pummeled with headlines, and so it's perhaps understandably taking a serious step down. And also other markets, there's less liquidity. U.S. is closed today, so there's that as well. But the earnings picture is still attractive to you. It still looks like, again, it's got its sea legs.
Yes, and actually, if we go to slide 11, it's whenever I do my entire chart download on Saturdays, there's always a couple of charts that are like, wow, for this week, this was one of them. It shows the year-over-year change in the forward earnings estimates from the MSCI database. And so the US is at 14%, meaning its forward estimate is 14% higher than a year ago, which is different from the 12% I showed earlier, because that's the trailing number and its growth rate from a year ago. But so earnings estimates are up 14% in the US, but they're up 23% in EM and 17% in IFA. And so there is a very clear acceleration there, which of course explains the blue bar at the bottom, which is the excess return of ex-US stocks over US stocks, which is now 18%. Because price follows earnings, of course. But so the acceleration in earnings estimates outside the US is not only holding, it's accelerating. And so that gets me to slide 12, which is again going back to the DCF math that I showed earlier. And here I'm looking at the expected earnings growth rate in the vertical, and what's called the required return or the cost of capital in the horizontal. So if you take the risk premium of a market and you add their local risk-free rate, you get a required return. And the way the DCF model works is you are assuming that the current price is the correct price, and you look at what the earnings expectations are, and then you solve for the required return so that the price makes sense. So for instance, for the US, the required return is 8.6% at an earnings growth rate of 13% and a PE of 25. And then when you subtract the 8.6%, when you subtract the 10-year yield from the 8.6, you get 4.2. So that's where that risk premium came from a few slides ago. If you take IFA, they're pricing in a 9.3% risk-free required return at an 8.5% earnings growth and a 17.2 PE. And so to me, that is the contrast. So EM is very interesting, of course. It has even better expected earnings growth and, of course, a lower PE because it's EM. But to me, if there's a surprise, IFA is not priced for earnings acceleration, while the US is priced for success. So to me, maybe there's a mean reversion still in the cards there. And just to kind of take this one step further, if we go to slide 13, we can see that the MSCI IFA index is now outperforming the S&P both on a cap-weighted and an equal-weighted basis. Those are the two squiggly lines with the blue shading. So there is technical performance to accentuate the fundamental improvement as well. And in IFA, about 75% of the stocks are in uptrends, and actually globally about that many are in uptrends as well. So this is really a global broadening. And yes, the headlines today are going to maybe cause a correction, but not much has really stopped this train, right? I mean, the same fears happened 10 months ago during the tariff tantrum, and those stocks have still done well. So I would see any setback here as a buying opportunity, if anything.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So just to sort of add to that, I was going to ask you what you think we know now about the tariff scare of April of last year that we didn't know then. And I guess it goes to sort of the seriousness of the negotiating, really.
Yeah, and I think, it's the tariff tantrum of last March and April, I think was a good lesson for a lot of us, including myself, that these things generally are not sort of monolithic things that only they will influence prices and earnings. They can, of course, if they're big enough. And when we had that so-called Liberation Day, the numbers were really big. They were walked back from fairly quickly. And I think the effective tariff that has been in place ever since is about 12%, I think. And that, of course, is a big number, but it's not big enough to really unravel the bullish fundamentals. And also they are offset by, of course, other things, right? We had the One Big Beautiful Bill Act, the whole AI boom and its downstream benefits on the economy. So it's just a lesson to me that it's a mosaic and that there are cross currents. So for instance, American consumers have paid for the brunt of the tariffs, but oil prices are way down from a year ago, and that helps as well. And actually, I'll show you, where is my, if we go to 16, the inflation numbers are okay. They're like 2.7% is the current CPI, still above the target, but not that much above it. But we have this indicator called the Trueflation Index, right, which is an algorithm based on actual real-time prices. It's a daily index, and it's pretty volatile. So I don't want to read too much into it, but you see the red line there.
Yeah.
That true inflation index is down to 1.7%. Wow. And so, of course, a year ago we were looking at tariffs undermining profit margins and increasing price inflation, and none of those have happened, either because the tariffs weren't big enough or they were offset by other factors, and probably a combination of both. But it just shows that there's always cross currents. There's always this mosaic of things going on, and tariffs, in retrospect, at least for now, were the dog that didn't bite, or didn't bite a lot.
Yeah.
And so that's why the bull market has been able to continue, and the Fed's been able to ease closer to neutral. And so it's a good lesson for all of us, because a year ago we were thinking about, holy cow, what is this going to do? And really not much has happened.
I mean, it is interesting as well, because oil is one of the reasons that basically everyone could manage through, one of a few in that mosaic. And just days before, well, weeks, I guess, before we hear this new tariff threat to European nations, Venezuela happened, which was another reason why oil dropped, days before this another tariff announcement. So it's just sort of interesting, again, how to watch those offsets that you're pointing out there, and how that ultimately will work. Today is a day for gold, however, because of the volatility, and perhaps it will even out and the balance will return. But what are your expectations for gold going forward? There was a thought it had peaked.
Yeah, so page 20. So gold is a train that keeps on moving, and I think it's part of the global multipolar realignment, right? You look at the spheres of influence that we discussed last week: China, Russia, the U.S., the Monroe Doctrine or the Donroe Doctrine,
Yes.
And how the world is sort of being divvied up into spheres of influence. And if you're China or Russia or another country that is aligned with China or Russia in those blocks, you're going to probably trade directly with those blocks and not via dollars.
Right.
And that means that the flow of global reserve currencies changes. And the dollar is still dominant. It's 56% of global currency reserves. But gold is, ascendant in that sphere, for obvious reasons. And so we have that geopolitical realignment going on. And we also have, a global economy that's reaccelerating. We saw that in the earnings estimates. We see this in the global money supply. The red line in this chart is the global money supply. It's $116 trillion. And per the blue bars in the bottom, it's growing at an 11.4% annual rate of change. That's pretty robust money supply growth. And of course, gold is nothing if it's not a hedge against monetary inflation, and that's exactly what gold is doing. But what I think is interesting is that it's broadening, right? We know the story in silver, we know the story in copper. If we go to slide 19, here I show the Bloomberg Commodity Spot Index, which shows a beautiful rounding base. The commodity sensitive stock index in the bottom has broken out nicely. I mean, these are a chartist's dream.
I was going to say, you find that beautiful. Yeah, that's really interesting.
But to me, it illustrates that, in a fragmented global world order, commodities are going to be a strategic asset. I mean, they always are, but they're going to be even more so, right? In the days of true globalization, labor becomes fungible, right? It's like that's the labor arbitrage. Yeah. Capital is fungible. Commodities are fungible. In a fragmented world that gets essentially divvied up into spheres of influence, those buckets of labor, capital, resources get divvied up as well, and then commodities become more strategic as an asset, and they become less fungible, which means that they get hoarded more. And so I think that's kind of the story here. And the nice thing about commodities is that they are the ultimate diversifier. They don't always do well. As a matter of fact, they often don't do well. but they have basically a zero correlation to stocks or bonds, and that makes them an interesting diversifier, especially at times like this.
An interesting diversifier. Would you go so far as to say that we are in the midst of or heading towards a commodity supercycle for quite different reasons from last time? I mean, last time it was China gaining its footing in a million different ways and an insatiable demand. This is almost a retreating, in a way, reason for it. But would you go as far to say that we're approaching that?
Yeah, I think so. I mean, the world is deglobalizing.
Yeah.
And so when you think about what were the hallmarks of the globalization era that started when China joined the WHO back, a few decades ago, and that was that everything became fungible, right? So you had companies going abroad. China became the global manufacturing, and there was a labor arbitrage, not only in China, but Eastern Europe. And so if we have a deglobalizing world, the opposite would happen. And that means, again, capital gets fragmented. We see that through gold. And labor gets potentially fragmented. We would see that through potentially higher inflation, and resources get fragmented. And we see this in the rare earths, and we see this in Venezuela, right? It's like, and so that it's a less efficient, less global, and less fungible system, and that's going to cause more friction and more supply constraints, because you can't necessarily replace one supply chain with another as quickly as you could during the globalization days. And so it creates more friction in the global economy. There's always a geopolitical overlay, and I think commodities are probably in the sweet spot to benefit from that.
So if I don't know much about hockey, but to use a hockey phrase, if you're skating to where the puck's going, what does it mean for asset allocation?
So bonds have actually been doing well. They are actually once again negatively correlated to stocks, at least over the last 12 months. So, equities are always going to be the anchor for a diversified portfolio. I think very much global equities. When I talk to my colleagues in asset allocation, generally they are long beta, but short the U.S., meaning they're overweight international. And I think that's exactly the right way to do it. The fundamentals of the market are good, so you don't want to be short the market here, but you don't want to be long where the juice is, if you will. Bonds are still an anchor. I wouldn't be too much into them, because at 4.2%, I don't see a tremendous amount of value in long duration bonds. And then from then we go to gold, and maybe as a final slide, we can pull up 22. Bitcoin, I still think Bitcoin is going to take a year off this year, but if you look at the momentum curves of the various assets that I track, Bitcoin is clearly the outlier. It's all the way at the bottom and starting to hook up a little bit. So maybe Bitcoin starts to rejoin the fray, if you will. And so, a broadly diversified portfolio of stocks, bonds, alternatives, gold, commodities, Bitcoin, maybe some tips. I think that, that's been my mantra for several years, and it continues to be today and for 2026.
Well, we are delighted that we got this break from the overall headlines and got to speak with you and take us through those incredible charts for sanity for all of us. Jurrien Timmer, thank you for joining us today.
Thank you very much.
Have a good week.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.